The boardroom was silent, save for the low, rhythmic hum of cooling fans. Michael Saylor stood before the wall of monitors, his presence casting a sharp shadow against the polished mahogany table. He did not blink. His attention was locked onto a single, flickering data point that pulsed with a steady, haunting intensity. The screens bathed the room in a cold, electric blue light, highlighting the stark white digits that refused to settle. 11.5%. It was a number that defied the standard market gravity. Saylor reached out, his finger tracing the jagged upward spike of the chart against the glass. He pressed his hand against the surface, feeling the faint vibration of the hardware. The air in the room felt heavy, charged with the weight of a calculation that few in the financial world had dared to execute. Outside, the city lights blurred into streaks of motion. But inside this room, time had narrowed down to this one glowing metric. He stepped back, the red laser dot in his hand hovering over the percentage, waiting. The screen refreshed, the number held, and the game changed. This was not a fluctuation of the market. This was a calculated strike. Saylor turned from the glass, his movement sharp and decisive. He paced the length of the table, his footsteps echoing against the hardwood. He stopped, facing the team, and swept his hand across the air as if clearing away invisible clutter. "Look at the charts," he said, his voice cutting through the hum of the fans. Most analysts see a rock. They see a lump of digital gold locked in a vault, static and heavy. He shook his head, a ghost of a smile appearing. They are wrong. A rock does nothing. A rock sits and gathers dust while the world moves on. He tapped the table once, twice, for emphasis. We're not looking at a mineral, we're looking at a machine. A kinetic engine designed to output work. He walked back to the monitors, pointing to the yield curve that snaked across the display. A machine creates its own momentum. It takes raw energy and converts it into a sustainable force. That is the architecture we are building. Not a vault, but a jet engine for the modern economy. He looked at each person in the room, waiting for the shift in their perspective to take hold. The room held its breath. He was no longer talking about price. He was talking about mechanics. Saylor pulled a digital schematic onto the main screen. It was a complex web of lines and nodes, far removed from simple price charts. The strategy is simple in theory, brutal in execution, he began, his laser pointer tracing a circuitous path through the data. We wrap the asset in a layer of corporate debt. He paused, letting the statement hang in the air. We take the inherent volatility of the market and we weaponize it. We turn that chaos into a barrier to entry that competitors cannot cross. He gestured to the debt structure, showing how it acted as a firewall. By issuing notes secured against the underlying asset, we effectively change the rules of the game. He tapped the screen, highlighting the debt maturity nodes. We are not just holding a position, we are building the fuselage of a passenger jet. The volatility is the thrust, but the debt structure is the airframe that keeps the vessel level. He moved the pointer, showing the flow of capital moving through the corporate layer. This is how we insulate the core. We force the market to climb our wall of debt before it can even touch the underlying asset. He leaned in, his focus absolute. We are re-engineering the very nature of risk. Saylor tapped a different section of the monitor. Two distinct tracks emerged on the graph, one jagged, one steady. Look at the common stockholders, he noted, his tone clinical. They are the ones holding the bag during market dips. They take the full force of the price swings, absorbing the impact like shock absorbers on a car. It is a rough ride for them. He traced the steady line of the credit investors. But then, look here. These are the people sitting in the cabin. They're not exposed to the turbulence outside. He clicked a button, revealing a stream of capital flowing into the credit accounts. They receive a synthetic yield. It is a steady, predictable stream that acts exactly like a high-yield bond. He stepped back, letting the contrast sink in. This is not magic. It is pure financial engineering. When the market dives, the common shareholders feel the jolt, but the cabin remains level. The credit investors collect their dividends regardless of the noise on the charts. By separating the participants, we create a structure that functions independently of the chaos. We have effectively built a sanctuary within the storm. The volatility is still there, but the structure holds the weight. Every transaction we execute is designed to keep that cabin floor stable while the rest of the market shakes. Saylor turned to the balance sheet projection, his hand pressing firmly against the glass. Now, we initiate the debt issuance. He highlighted the line where Bitcoin moved from an asset to collateral. We are not borrowing against revenue. Revenue is fickle. We are borrowing against the physics of scarcity. He traced a supply curve, showing the fixed, immutable limit of the network. The market is conditioned to value companies by their cash flow. We force a re-evaluation. He clicked, and the screen flashed a series of collateralized notes. Because the underlying asset is finite, the market stops viewing risk as a variable of sales and starts viewing it as a variable of supply. He watched as the debt maturity dates aligned with the projected growth of the network. This is an experiment of massive scale. We are stripping away the reliance on quarterly earnings and replacing it with mathematical certainty. He stepped back, the glow of the data illuminating his face. We are leveraging the balance sheet to turn a digital scarcity into a liquid engine. It is not just a loan. It is a fundamental shift in how capital perceives value. The system is no longer waiting for profit. It is waiting for the next block to be mined. The mood in the room tightened. A secondary screen flickered to life, showing the historical volatility of the underlying asset. The lines on the chart were jagged, sharp enough to cut. Critics in the industry had begun to speak, and their message was a singular, relentless warning. They pointed to the peaks. They pointed to the sudden violent drops. It is a house of cards, the consensus echoed. The data on the screen seemed to pulse with that danger. Every time the chart spiked, a red alert flashed in the corner, signaling the potential for total systemic ruin. The pressure in the room was palpable. It was no longer just a technical presentation. It was a defense against a tide of skepticism. The critics argued that no amount of engineering could tame such wild, unpredictable movement. They traced the history of the asset, highlighting every crash, every panic, every moment where the price had plummeted into the abyss. They framed the strategy not as genius, but as recklessness. The air grew heavy. The glowing numbers on the board now felt less like targets and more like liabilities. The critics were watching, their eyes fixed on the inevitable day when the volatility would finally break the structure. The challenge was laid out in cold, hard, visual evidence. Saylor did not blink. He walked to the center of the room and tapped the screen, dragging a new layer of data over the jagged, red alert chart. "You see chaos," he said, his voice cutting through the tension. "I see a schedule." A series of blue bars materialized, perfectly aligned to intersect the volatility peaks. These were the debt maturity dates, spaced precisely to coincide with the network's projected growth cycles. He did not argue against the price swings. He neutralized them. By locking the debt obligations into long-term windows, he stripped the fear from the volatility. The market was betting on the next minute, but his strategy was betting on the next decade. He traced the intersection points where the maturity dates met the projected network adoption. The necessity of the network is the only constant, he stated, his fingers steady against the glass. Volatility is just noise for those who do not have a plan. We have the plan. He zoomed in on the debt maturity dates, showing how they provided a buffer, a structural floor beneath the digital asset. The red alerts faded, replaced by the calm, rhythmic geometry of the maturity schedule. He had turned the danger into a calculation, proving that the structure was not just surviving the market, it was dictating the terms of its own stability. The room went deathly quiet. The blue bars of the debt schedule remained on the screen, but their meaning had shifted. Outside the boardroom, the financial world began to react. The distinction between a volatile digital asset and the bedrock of a sovereign bond was evaporating in real time. Traders in global hubs stopped looking at the volatility as a bug. They began to view it as a feature of a new, harder money. The traditional hierarchy, built on the slow decaying returns of government debt, shuddered. It was a tectonic movement. Algorithms that had ignored the asset class for years suddenly adjusted their parameters, recognizing the structural integrity Saylor had engineered. The boardroom monitors displayed the global impact, a ripple effect of capital flowing away from stale, yield-poor bonds and toward this new, synthesized engine. Old-world financiers watched their assumptions crack. The boundary between speculative risk and institutional stability was no longer a wall. It was a ghost. Saylor stood back, watching as the market data confirmed the collapse of the old paradigm. The digital asset had been tamed by the debt structure, and the global financial infrastructure was now forced to acknowledge the new anchor of the economy. The shift was absolute. The sovereign bond was no longer the only gold standard in the room. The impact moved beyond the institutional trading floors and into the quiet lives of those who had spent decades chasing safety. In suburban offices and home studies, the calculation was simple. Government bonds, once the reliable bedrock of retirement, now offered returns that struggled to outpace the erosion of currency. These individuals looked at the screens, saw the structural integrity of the digital yield, and made a choice. They liquidated their bond portfolios. They moved their capital into the new instruments. It was not a gamble on price, but a shift toward a new form of reliable income. The volatility that frightened the speculators was ignored by those who understood the underlying debt maturity. They watched as their quarterly distributions arrived, consistent and predictable. This was the true test. When the market dipped, they did not panic. They checked their accounts, saw the interest generated by the collateral, and stayed the course. The strategy had moved from a boardroom whiteboard to a functional tool for personal survival. Every successful payout reinforced the shift. The fear that once dominated the digital space was replaced by the calm reality of a monthly check. Saylor watched the data flow from these personal accounts, confirming that the structure was holding firm against every market swing. The era of the stagnant, low-yield retirement was coming to a close. Michael Saylor turned from the monitors and faced the room. He did not speak. The silence in the boardroom was absolute, heavy with the weight of the data that had just been proven. He walked to the center of the display wall, his hand steady as he raised a laser pointer. He moved the dot across the complex charts, past the volatility markers, and finally, he let it settle on the glowing number 11, 5%. The red light pulsated against the glass, a beacon in the dim light of the room. It represented more than a return. It was the proof of the engine he had built. He cut the beam. The room remained dark, lit only by the static glow of the performance metrics. The era of the stagnant asset was over. The screens pulsed with the new reality, a digital horizon that stretched far beyond the old boundaries of the financial world. Those watching realized the shift was not coming. It was already here, humming in the background of every transaction. Saylor stood motionless, watching the reflection of the numbers in the eyes of his team. They saw the future in the yield. The architecture of the economy had been redesigned, and for the first time, the path forward was clear. The era of the digital yield had begun.